Hey guys, this is Chris Mancola with the Mancola Group with West USA Realty. And today is our weekly housing market update. And I'm going to share my screen with you here real quick. And I'm just going to show you some things that the media is saying over the last few years. And it's really interesting. I feel like this is what we hear all the time. Ever since the last crash, we hear this constantly. And if you look at each one of these, I'm not going to read each one of them, but if you kind of take a look at this chart, all the way from right after the crash, a few years after the crash, and when things started going up in price, probably around 2011, 2012, in most areas, prices started coming up. People were getting great deals at the bottom of the market back in 2011, 2012-ish. And when things started to pick back up again, your average or median home price back then was 300,000. And if you listen to the media and all the things that they were saying listed right here, each one of these years, you can see over on the right hand side the appreciation value for each one of those years, how much that means added on to that each one of those years from starting at 300,000 back in 2015, and then where you would be at by the end of the chart. And if you had listened to them, all the money you would have lost. So not really too accurate as far as the media is concerned when it comes to economics in the housing market. It stands to reason. They're sitting up there, with their jobs, basically not running businesses, and they're looking to get clickbait these days, right? Clickbait. They want you to click on the headline, and a lot of times you read the article and it doesn't really make sense with what's going on, or isn't really what the headline was about. It's all to get you to click on the articles and do your subscriptions and all those sorts of things. So keep that in mind. When you're listening to this stuff, I did a couple of other videos getting into more details on this, the history of recessions versus the housing market appreciations and all that. Go back and listen to those. Of course, subscribe to us, and follow us on YouTube, Facebook, Instagram, and Rumble. Also on Twitter. Make sure that you're keeping up with what's going on with the market. But I did a couple of videos on, is the housing market going to crash? Now, I want to go through this week's housing market update, but I want to kind of go through some things again real quick, just to make sure we're on the same page with the housing market now versus the crash, because we keep hearing this. No matter how much you show data, it seems like people are just engulfed in this ridiculous information that's out there. And it's not to say in certain areas, real estate is certainly regional, and you always got to be able to afford what you're trying to buy and all those sorts of things. But, between the way that people have to be qualified these days since the crash, and the regulations there, which weren't in place before the crash, and the amount of equity people have these days, and some other factors that I'm going to go through, it's nothing like the 2008 crash. So, with all the regulations and equity in place, along with these stats. So take a look at this. The average days on market before the crash was 130 days. Okay. Right now, right now, our average days on market, average cumulative days on market in the Phoenix metropolitan area is 40. Okay. So from 130 to 40. All right. And then if we go back to 2017, the average days on market was 63.75. So 64 days on market. So 63 is more than 40, right? Where we are currently, we're at 40 days on market, 63, and right before the crash, it was 130. So that means that's how long it's going to take to get your property under contract and sold. 40 days right now on average. So as you can see, during the crash and back in 2017, we're doing much better now. So keep up. I'm going to keep going through these numbers here really quick. Back in 2018, we were at 58 days on market. 58 days on market. I'm sorry, 59 days on market. I need my glasses. 59 days on market back in 28. And this is, again, August of each of these years that I'm going back to. August 2018, 59 days on market. All right. So if we go back to 2019, again, we were at 59 days on market in August of 2019. 59 days, average days on market. Okay. So again, if we kind of look at where we're at, we look at August of 2020, the year of the shutdown, of course, we we're at 47.74 days on market. And again, if we look at 2021, August of 2021, we're at 27 days on market. But of course, that was the anomaly year, right? That was it started a little bit towards in 2020 we had some crazy stuff happening, but in 2021 we had the big anomaly year where we saw this crazy insanity market where things were going under contract in a matter of hours, or minutes sometimes it seemed like. But 27 days on market in August of 2021, no surprise there. Anomaly days on market, anomaly equity gains, anomaly everything when it comes to 2021, of course. So when we look at September of where we're at right now in September, we're at 40 days on market. Okay, so if we look at those years, obviously with everything taken into consideration and within the context of what was going on, again, what does that tell us? Well, we're in a pretty brisk market for the Phoenix metropolitan area. And, as far as the history is concerned, we're actually ahead of those years, except for the anomaly year, which, okay, it was the anomaly year. So again, all the hysteria, again, we've got to really be careful with all the hysteria. And again, in some areas of the country, real estate may not be doing that great. Okay. If you've got a lot of high crime areas, you've got other things happening. If you look at real estate in New York compared to Miami or Phoenix or, somewhere up in Wyoming, it may, you're totally different type of real estate in regional areas. Okay. So let's look at the sales price to list price ratio again, coming right straight from the Crawford report, which is our local guru institution. It pulls all the data straight from our MLS and kind of packages up nice and neat for us. The sales to the list price ratio right now is 97.8%. Now, what does this tell us? And what does what I just showed you so far tell us? That we're basically in a pretty brisk market. We're in a kind of a normal market, a balanced market for that matter. And there really isn't anything to go crazy about. It's just that we went from, the anomaly insanity year. Okay. We hit the real estate lottery if you owned a home, okay, or homes. And now we're back to normal, because usually we're going to be right around that high 97.8-ish mark or net range, or around 98%, maybe 98.2%, somewhere in that range is pretty typical for our market. And if we go back and we look at some of the other years, like for instance, April of 2019, we were at 97.8%. Okay. If we look at, August of 13, going all the way back to 13, and basically all the years leading up to that, we were at 97.8% of August in 2019, 97.8%, same place we are now. March of 2012, we were at 95.4% list to sales price ratio. Okay. Now, of course, when we were in the anomaly year, that overall average for the 2021 year of 2021, we were at 101.7. So most homes were selling over the list price, basically. So now they're just kind of in a balanced market. They're just kind of in that normal, there's some price reductions happening, but very slight price reductions. There's some closing costs given, and we're going to get more into that. But this is kind of a normal market around that 97, 98%. 101 is not normal, or over 101, that's not normal, but that's where we were last year. So, and if we go, kind of back further from 2012, we see that we were 95 then. So we're actually kind of overall as a, Phoenix metropolitan area, we're kind of been, the last 7 years or so, we've kind of been in that 97.8 range. Again, normal, except for the anomaly year. So price cuts. Let's take a look at price cuts and what's normal there. Now, it's important to understand that the overall appraised values are not coming down. Those overall appraised values, just again, you hit the lottery, and you're not going to hit the lottery every year, but you're still going to have an income, right? So, instead of seeing crazy gains. We're just going to see normal gains. What's a normal gain? Normal gain, you know, in our area again is going to be about 4.5%, 5%, maybe 6%, maybe even up to 7% in certain parts of town, communities, subdivisions, and certain types of homes. But price cuts, if we go back to September 1st of 2019, we had 1,509 price cuts, okay? If we go back to April of this year, we had maybe 400, or even in February, we had 400 price cuts this year. Yeah, it was kind of crazy, right? You know, and now if we go back to December of 2019, I'm sorry, and if we go to now, to right now, we're seeing that we're at 3,800 price reductions that are happening. And the reason for that is we're seeing that, first of all, we had a surge of inventory that happened at the same time of our slow season, or one of our slow seasons. Usually it's pretty slow around July and August, and I've mentioned this before in other videos. So it's not uncommon that there may be some price reductions, things move a little bit slower, just because our high season for real estate is going to be usually April, May, kind of starts a little bit in March, maybe even a little trickle in from February, but usually it's April, May, first part of June, and then things kind of fizzle out because people are going on vacation. They've already made their home purchase. They're going on their vacation. They're moving. They're you know, doing their other things, and it's so hot they don't want to be out there shopping for homes. So it's pretty typical. People are taking vacations right up through August, even through Labor Day, even this week, even after Labor Day through this coming weekend. So after that, we see usually it kind of picks up a little bit, you know, towards the mid to through October, maybe first, second week of November. It's pretty brisk. And then right after that, it kind of just, because of Thanksgiving and Christmas, right? So we will end up with actual closings. Quite a bit of closings happen right at the end of the year. But as far as people out shopping and properties going under contract, usually around first, second week, you know, end of October, first, second week of November, things really kind of die down. So that kind of gives us a little bit of a picture of what's going on there. And remember, we are higher in our price cuts also right now because, you know, we had a lot of people who were still basing everything off of what was happening before. And I'm going to talk about the price cuts more in a minute, and I'm going to talk about what they actually look like in reality. But they were going for those insanity prices, and you're not going to hit the lottery every year and every week. It's not going to happen. It doesn't, you know, it's just anomaly. It's an anomaly. So we got to get back to reality. We're in a balanced, normal market. We're going to have normal gains and normal pricing, normal days on market. Okay, so normal equity gains. Percent of closing with seller paid or assisted closing costs that are noted. So in December 29th of 2019, we were at 25% closing costs. Now that's pretty normal, 25% closing costs given to the buyer to buy down the rate or pay for, you know, their title and escrow fees. That's pretty normal, 25% of the overall market. That's kind of normal average, okay? So the where we're at right now is we're at 15%. So we're actually not even to that point yet, okay? It has risen, that's for sure, because back around April, May, you know, February, April, May-ish, we were around probably 3-5%. So it has risen, but we are definitely at 15%, and I would say more of a normal market. If you go back to 2019 and back, you'll see that 25% is kind of the normal range, pretty typical of the total overall market. So we look at the Crawford Market Index, okay, this gives us, and I talk about this every week, this gives us kind of an overall idea, kind of basic generalized, we're using round numbers, where we're at in the market. If the numbers are below 90, then we are, the overall numbers are below 90, we are in a buyer's market. If they're over 110, we're in a seller's market. And if the supply numbers and a demand number match, doesn't matter what those numbers are, but if they match, we are definitely in a balanced market. Okay, makes sense. Supply, demand, same or equal to or match, those numbers match, we're in a balanced market. So 100 is kind of the mid range of that, and the range, total range, is 90 to 110 is balance. So right now the overall index is at 106.5. 106.5. That means we are in balance. Okay, we're in the balance range of 90 to 110. Demand is at 79.2, which is overall on the index would be, basically 20 points below 100. Okay, 20 points below 100, that mid range. And supply is at 74.4, so 25, 26 below 100. But remember, supply and demand, if those numbers match, we're in a balanced market. Well, supply is at 74.4, demand index is at 79.2, which actually the demand actually went up a little bit, okay, along with the supply from last week. And last let me see here. I think I had it up. Let me see. Oh, I'm sorry. I thought I had the numbers up for week over week. I guess I didn't. Oh wait, yes I did. September. Okay. Oh wait, I'm sorry. Okay, that was my bad on that. So let me get back to normal here. Okay, so actually, yeah, so we're at 106.5. Demand is at 79.2, and supply is at 74.4. And last week we were at, oh geez, I had this backwards. I'm sorry, guys. Okay, so August, the end of August, we were at 106.5. Demand was at 79.2, and supply was at 74.4. My bad. Okay, I had these switched. My bad. So right now we're at 105.5. 105.5. Okay, so we are getting closer to the balance mark of 100, from 106 to 105, and the demand last week was 79.2. This week it's 79.7. So the demand has actually creeped up a little bit. And last week we're at 74.4 on the supply, and this week we're at 75.5. So the supply and demand has gone up, and we've seen that the actual overall index is actually closer to balance than it was last week. So again, we're just in a normal market. Just in a normal market. We went from insanity. Okay, you went from getting a lottery 1 year, you got a lottery, and then this year you're getting your regular paycheck. Okay, on your equity gains, but you're still making money. Okay, you're still making money. You're still making the average equity gain. Okay, monthly median sales price. Monthly median sales price. This will give us an idea on where we were, where we are. So at the peak, we're at 480. The peak, we're at 480. And let's see, that basically, let's see. Yes, 480. So we're at 480 as of May, right around April. Right in the beginning of May, end of April, we were at 480. That was our peak median sales price. Okay, median monthly sales price 480. And 2021 we're at 390. 2020 we were at 293. So you can see how fast the crazy insanity market crept up on us. Now we are at let's see, as of median monthly sales price as of September 3rd was 444.9. So almost 445. Okay, 445. That's up from 401 from last year, and the year prior of 2020 was 325. Okay, so we're still right up there, but we have seen an overall. Now remember, these median numbers, these average numbers are going to be influenced if you know, looking at basic, you know, averages in math and how things would kind of calculate out. If we've got a higher inventory, like, you know, back in February, March, we looked at the inventory and we had, like, you know, 5,000 properties for sale or whatever, you know, 4 to 5, 6,000 properties for sale versus 18 to 19 where we are now. So those overall averages, and the biggest chunk of that is going to be under 500,000. So obviously that's going to bring your averages down. It's going to change the median prices and all those sorts of things. Oh, and yes, along with the price reductions, because people were still basing their comps off the insanity market, which, you know, supply and demand dictates, along with interest rates for sure. So all that definitely switches when we're looking at the overall numbers. So keep that in mind. Got to look at, you know, what's going on in your current area, kind of see what the trends are, what's going on in contract, also what the most recent sales are, what's going on in contract, what's going up for sale, and how long it's sitting there too is a good indicator. And what are the true comps, like, you know, and what homes look like that sold, and did they have pools and all the extras. So of course we do that and really drill down on those numbers. But the monthly average sales price per square foot um in September, you know, now of 2022 would be looking at it per square foot would be 303.4. Okay, so basically what we're seeing is the overall numbers, and the average decrease is, you know, right around 6%. Okay, 5 to 6%, depending if you're looking at, you know, the median or the average, it's right around 5 to 6%. So when you say, well, yeah, but how much is the shift, and what does that look like, and what should I price my home at? The overall average would be, you know, figure about 6%. Okay, every you know, area of town, if we look at the index, is going to be a little different. You know, obviously regionally, when it comes to other areas of the country, it's going to be different. But right now, what we're seeing is about 6% shift in pricing. So if you don't have any other comps and you're trying to base everything off of what happened, that's kind of a pretty good indicator of what maybe to expect when pricing a home. Again, there's other factors, but that's kind of an overall generalization of what's going on. The monthly average sales price per square foot then is 303. Now last year would have been 248.81, and in 2020 179.79. So that kind of gives us a little bit more idea what's going on there. And that price per square foot, I'm sorry, price per square foot of 303.45 was back at the peak again, right around May, end of April, beginning of May. That would have been 303.45. And right now it's 286. I apologize. That's the difference in the pricing. So 286.79 is where we are now. Okay, where we are now. Monthly median sales price, if we're looking at the median numbers, again, was 480. And that was our peak. And, you know, we definitely have seen the shift, as I mentioned before, but it's about a 6% difference of where we were at the peak of the insanity market. Overall, the cities, we just saw in the past week, cities, because we were seeing a steady decrease in all cities on the Crawford market index, that we saw a decrease in the overall index of it being a seller's market into a balanced market, or in some areas even a buyer's market to an extent. But if we look at the current overall picture, it's pretty interesting, because Paradise Valley was basically the place where held its numbers the best, has actually had an uptick of 2%, 2% uptick in the CMI or Crawford Market Index. So that is up to 194. All the other cities are down, but the overall averages were dropping, you know, at up to 38 last month, or the month prior to last month, 25%. Then last month it was 20%. And now we're actually seeing where some areas are actually going up. So so Scottsdale also saw a 1% increase. And that is at 132. So that's obviously in a technically a seller's market. Chandler saw a 2% increase, and Tempe saw a 0.1% increase, but those were increases nonetheless. So obviously the bulk of our market as far as pricing is concerned would be between like I said, that under that 500,000 mark, and then the overall bulk would be between 300 to 1.5 million as far as our pricing is concerned in the Phoenix metropolitan area. And those are going to be the toughest for sellers in those price points. But we have seen, again, an overall drop in sales price median of 6%. Okay, so beginning of May was the peak, and the average sales price per square foot is down about 5% overall. And then for May we saw 363 per square foot happening. Now we're seeing 320 a square foot. Okay, the list price, the overall list price, is 363 in May, now 320. So that's a total down as far as the list prices. Again, it's list price, which is different. The list price is down by 12%. Why? Because people are starting to catch up with the idea that I can't get what I was getting before, and people are trying to price their homes to sell when they do price them. Okay, but list price and sales price are definitely a lot different. Now it's kind of crazy too, because in some cases we are still seeing, in some cases, for those total turnkey trend homes, maybe with a pool and resort style backyard and outdoor kitchen and all the bells and whistles, we may see, still on some of those type of properties, we may see multiple offers. So they're still out there, they're still happening. It's just not as frequent as it was before. So instead of having 3 or 5 offers on a house, more of a balanced market. We may have 1 or 2 offers on a property, or maybe you get lucky and get in there before the weekend and nail down a property and get it under contract. Okay, it's always best to shop for properties in the middle of the week, right? And be completely pre-qualified or have proof of funds ready to go for a cash purchase. So, also keep in mind too, another thing with these price reductions is a lot of the iBuyers, and some of the other maybe not so savvy investors overpaid for properties when they bought them. Even if we go through the MLS, we've seen this all the time, all the way back to the peak, and maybe even before. Properties are just sitting there and they're lowering the price on those maybe a week or every 2 weeks. And remember, they way overpaid. There were some times where I saw iBuyers, I could not believe what they were offering on properties. I mean, it was 25, 50,000, sometimes 80,000 or more over what the property was worth. It was absolutely insane what we were seeing out there. In some cases, I want to say it was even 100,000. I could not believe what was going on. So now they're doing their price reductions, and they're doing them every week or every other week, and those sorts of things, because they way overpaid. So, they don't want to lower it all at once and get it where it really should be, because they're trying to get the most out of it. But they have properties I've seen sitting out there from the iBuyers, for 90 days, 120 days, and so on. So that's another factor in the mix here with some of these price reductions and so on of what we're talking about. So keep that in mind too. It's just not the everyday buyer and seller, and family or a single person that's trying to, sell their house. So anyways, I think that's all I've got for you guys this week. Properties are still selling if they're priced correctly, and they're ready to go and marketed properly. And it's just taken a little bit longer on average, but certainly nowhere near the crash. Remember, average days on market before the 2008 crash was 130 days. And right now we're sitting at about a 40-day average. Okay. We went through all the other pricing to kind of show you that we're really just pretty much overall in balance. Guys, if you have any questions at all, want more information about your area, selling or buying a property here in the Phoenix area or anywhere else for that matter, feel free to reach out to me. I'd love to, happy to answer any questions. You can call or text me at 480-788-8569. You can check us out at mincolahomes.com, mincolagroup.com. Email us at home@mincolagroup.com. Again, be sure to like, follow, subscribe, and share this information with your friends and family over on YouTube, Facebook, Instagram, Rumble, and Twitter. Okay, guys, we'll see you next time. Thanks.